Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 144th CP program organized by AASB of ICI for this council year. As we all are aware that we organize various knowledge disseminating programs for all our members. Today we are going to organize this webinar on the topic consideration of laws and regulations in an audit of financial statements. And in order to tackle this very important topic as well as one standard, we are having with us very learned speaker, CA Anil Sharma ji. So on behalf of AASB of ICI, I extend my warm welcome to you. Namaste, sir.
Thank you.
We are having with us Madam Ruchi ji Maheshwari ji as a moderator for today's webinar. I also welcome Ruchi ji on this AASB. So without wasting much more time, I request Madam Ruchi ji to please take further proceedings of today's webinar. Over to you, Ruchi, Madam, please.
Thanks, Anilji, and welcome to all the participants today. I think the Accounting Standard Boards, Auditing and Assurance Standard Boards is really doing a great job by sharing this knowledge with us. And actually, sometimes I really feel so nice because, we really forget to pick up the book and study, but going through these webinars helps us to quickly learn and recollect whatever we've learned earlier. So this is a really great step, and I feel really happy to be hosting this because along with this I learn as along with the speaker. So that's a great opportunity for me, and today it's a great session that we have on SA 250. It's a very important topic because as auditors, we all, while we're doing our audits, even not as auditors, even as companies and CAs, wherever we are working, it's a very important parameter that we all need to understand. And this topic, which is consideration of laws and regulations in an audit of a financial statement, it's an important aspect. And this standard really covers all aspects in terms of objectives, scopes, requirement, and all the various factors, which I think we will cover today. And I'll really be honored to introduce the speaker, CA Anil Sharma ji. He comes with great experience to us, and I think it will be nice to hear from him directly. Anil ji is a chartered accountant with more than 40 years of experience. He's been an adjunct faculty at with the Indian Institute of Company Affairs, IICA. He's been a past member of NAFRA, past independent director of UCO Bank, and actively associated with various NGOs working in the social sector. So his immense knowledge is really going to help us today. So I think the only role that we play, basically me as a moderator and you as participants, is just to have good questions for Anilji so that we learn more from what he's there to share with us. So over to you, Anilji. And we're looking forward for the session.
Yeah, thank you, Ruchiji, and very good evening to all the participants. And thank you, Anil Lalji, for once again giving me this opportunity to interact with members. As Ruchiji rightly mentioned, that this aspect of knowing laws and regulations has become so important especially for chartered accountants as a whether they are involved with the company as a CFO or any other capacity, as well as for the auditors, because it has been seen that the company doesn't act within the framework of just, let's say, Companies Act. It has so many other laws which are applicable to them, and some of the laws are so important because non-compliance sometimes even erodes the entire working of the company or even the existence of the company. And some of the laws, if non-compliances are there, then there are going to be heavy penalties, which again impact the financial statements, because then those penalties and fines have to be provided for. So from that point of view, and in fact, the public perception is also like that. We have seen that when interacting with the law enforcing agencies, they feel once the financial statements are audited by, are sealed by chartered accountant or the auditors of the company, then they presume that all the laws, whichever are applicable to the company, have been complied with, and auditors must have seen them. So in this background, and with a lot of expectation from the society, from the law enforcing agencies, and of course from the promoters also. Promoters also wants the professional to know what are the various laws which are applicable to them. Nobody wants to defy any provisions consciously. So if unconsciously something happens, so then there's going to be a lot of penalties and fines on them. So to avoid that, they want to know very well that they want to structure their businesses in such a way that all the laws are complied with. So that is the basic, I would say, the importance of this particular area. And from auditor's point of view, SA 250 is important because then it restricts us or tells us what is the scope, to what extent auditors are, because as auditors are not experts, they don't know all the laws and regulations which are applicable to the company. But then to identify which one of them are important and must be known to the auditors, they must examine those and see them thoroughly with regard to their compliances. And what are those other ones which are though applicable to the company but has no direct or significant impact on the financial statements. So that how to make that distinction, and what are those bases and what are those documentations and how that is to be done. I think SA 250 tells us the entire process. And if a auditor follows SA 250, then he can definitely ensure that from whatever expected from him, he has complied with that. So with this background, I have one presentation. So Ruchiji, if you feel any question in between, you can disturb me. There's no problem. Or if you feel that there is some question which requires explanation then and there, you can intervene. No? So I will take the presentation. Then we will go further on that.
Sure, sir. We'll ask you at that time, or definitely we'll have a lot of them at the end of the session for you.
Sure. No problem in that. So let's look at what are the objective of SA 250, consideration of laws and regulation in an audit of financial statements. See, first of all, this standard is designed, as I mentioned, that it is designed to assist the auditor in identifying, is there any material misstatement of the financial statement due to non-compliance with laws and regulations. So our ultimate aim is to ensure whether non-compliance of laws and regulations is resulting into any material misstatement of the financial statements. As you can see that our entire reporting is based on material misstatement only. So this essay deals with the auditor's responsibility to consider laws and regulations. What are those laws and regulations which they have to consider while performing the audit? And it doesn't apply to other assurance engagements in which auditor is specifically engaged to test and report separately on compliance with specific laws and regulations. Sometimes there are other assignments to auditors to give them a certificate or give them some kind of assurance that a particular law or particular regulation have been complied with by the company or not. So that is a separate exercise. But here SA 250 is with regard to the audit of financial statement, general purpose financial statement, and how to really look at the non-compliances of laws and regulation and linking with the possibility of identifying any material misstatement. So that's the overall scope of SA 250. See, since we use the word compliance with laws and regulations, or rather non-compliance with laws and regulations. So let's first understand what does it, whether these words have any specific meaning with respect to SA 250. So when we say compliance with laws and regulations, we are talking about those laws and regulations to which an entity is subject constitute the legal and regulatory framework. And the quick example is a company is regulated by the provisions of the Companies Act 2013 now. So it means that that is the main law or regulations that applies to a particular company. So the provision of some laws and regulations have a direct effect on the financial statement. And there are certain other laws and regulations which are to be complied with by the management, but do not have a direct effect on entity's financial statement. We will discuss this in detail. What are those which have a direct effect, which doesn't have a direct effect? So non-compliance with laws and regulations may result in fines, litigation, and other consequences for the entity that may have a material effect on the financial statement. So there are two stages. One, what are those laws and regulations which have a direct effect? And what are those, which are those laws and regulations which doesn't have a direct effect? And then which have a direct effect, what are the fines and penalties which may result due to non-compliances, and what is their impact on financial statement with regard to the if there is any material effect of those non-compliances or those fines and litigations emerging from the non-compliances. Because as we have seen in these days, almost all the laws are virtually giving per day penalty. It's like mostly there's a continuous penalties are there. So from that point of view, sometimes we have seen that very small non-compliance also results into heavy penalties, and which definitely have some material effect on the financial statement, because unless they are provided for, then the true and fair results or the financial statement or state of affairs will not be there. So from that point of view, compliance with laws and regulations. And if we look at from the other side of it, non-compliance, then what is non-compliance? Non-compliance is acts of omission or commission by the entity, either intentional or unintentional, which are contrary to the prevailing laws and regulations. So here a distinction whether those non-compliances occurred because of some unintentional reasons, still it doesn't make any difference, because if they have any material impact on the financial statement, they have to be taken care of, they have to be accounted for. And first of all, these acts of omission or commission, then these include transaction entered into by or in the name of the entity or on its behalf by those charged with governance, management, or employees. So the entire working, whether it is by the management, by those who charge with the governance or employees, all those omissions or commissions by the entity covers all the three, I would say, segment of that particular entity. One thing has to be made very clear, that non-compliance does not include personal misconduct, because when we talk about employees, then it is though entered into by him, but in the name of the entity or by him on behalf of the company or entity. So personal misconduct are not non-compliance with laws and regulations, so far as it may be result into any other consequence. Maybe it can be fraud or other things, but it will not be considered as, if it is a personal misconduct, will not be considered as non-compliance with laws and regulation by the entity. So once again, to make it more clear, we have to understand it in a more elaborate manner, which I will be doing it over the period. So first of all, when we talked about those laws and regulations to which an entity is subject constitute the legal and regulatory framework. While explaining that, I mentioned that for a company, the Companies Act 2013 is the main legal requirement which a company has to comply with. Then, if you look at even in the Companies Act, especially I can refer, the section 128, where it has been clearly mentioned. Sorry, 129, where it has been clearly mentioned that the 129 deals with the presentation of financial statement, the content and the format of that, and then it refers to Schedule 3. So it is very clearly mentioned there that those provisions would not apply to insurance companies, banking companies, or companies which are engaged in the generation and supply of electricity. And why that is given? Because there are separate regulators for such companies. They may be companies formed under the Companies Act, but their entire operations, their entire working is regulated as per the laws and regulations prepared by their separate regulator. In the case of insurance company, it is Insurance Regulatory and Development Authority. In the case of a banking, it is Banking Regulation Act and Department of Banking Supervision of RBI. And similarly, for the electricity company, it's a Electricity Act. So these acts have their own set of regulations which are applicable. So as against the Companies Act, these acts take the priority over the provisions of the Companies Act. Of course, other compliances of the Companies Act with regard to the operation of the company would definitely be applicable to all those companies which are formed under the Companies Act 2013 or 1956, if those were formed earlier. Now, let me give you some other examples. These were the three which are mentioned with respect to section 129, but there are some other also. For example, if you look at the case of non-banking financial companies. So once again, then a non-banking financial company is a company which is incorporated under the provisions of the Companies Act 2013, but it is very exhaustively regulated through the regulations framed by Reserve Bank of India which are applicable to non-banking financial companies. And one or three examples are non-banking financial company, systemically important non-deposit taking companies, and deposit taking companies directions 2016. Then non-systemically important non-deposit taking directions 2016, and core investment companies directions 2016. These are some of the regulations which are applicable to. And then if you really go through these provisions, you will find that in spite that company has been formed under the Companies Act, still it cannot function because these regulations have additional requirement of getting the registration or the license before they can operate. Then there are certain capital requirements, how much minimum capital they would be requiring. how they would be recognizing the income, how they would be, recognizing the income from investments, then uh, asset classification, provisioning norms, IREC norms, like in banks. Same in the case of NBFCs, there are separate, and the entire disclosure requirement of in the balance sheet are also specifically provided through the regulations. Then there are restrictions on even doing the business, how much they can invest in, let's say, in real estate, how much they can invest. There are provisions regarding concentration of credit and investment in one particular. These type of provisions are there, so which have direct impact on the functioning of the company, though it is a company which is formed under the Companies Act. So the point which I am trying to make, that this is a very typical example where you know that companies is a company and formed under the Companies Act, but the entire its functioning, its working, its compliances are governed by a separate set of regulations which has been prescribed by Reserve Bank of India. So we can say that in the case of a non-banking financial company, all these regulations, directions, which I have just mentioned in my slide, these are the important provisions, laws and regulations, which company has to consider in addition to the provisions of the Companies Act. And of course, when there are specific regulations, then general regulations doesn't apply. For example, let's take the case of, let's say, income recognition. So Companies Act may say so, but even accounting standard may say differently. But if Reserve Bank has given in direction how income will be recognized, that has to be followed, and that takes a priority over. So that is the point which is important, that why laws and regulations, some of the laws and regulations are so important, and auditor must be having full knowledge before they really take up audit of such NBFCs. Practically, I'm telling you that I have seen number of financial statement of non-banking financial companies, and in a very large number, I would say large number means maybe 60%. I'm not talking about very big companies, smaller companies, NBFCs. I have seen that the auditor was not aware of what are the provisions which are applicable to non-banking, how to recognize income. For example, if loans are given, they have simply recognized whether that loan has been received or not received. So that is one of the crux of this particular essay 250, that what are those laws and regulations which have a bearing on the direct bearing on the financial statements. Another example can be, we can see is like MSME Act. This is again a very peculiar provision which are there, and in fact these days it has become quite a controversial also, because this requirement is emerging from a different act, but is applicable to companies which are governed by the Companies Act. So you can see here that MSME Act 2006, there are certain sections 15, 16, 17, 22, 23, and 24. They are talking about that the payment to a MSME creditor has to be made by the company within a specified period, and that specified period cannot be altered even by mutual consent. And if not made, then certain interest has to be provided on the unpaid amount, and even that interest is not allowed as deduction from income, that also provided in the MSME Act section 23 talks about that. So these type of provisions have an overriding effect on other provisions of the law. For example, there is always a debate going on that if two parties have agreed for a particular term that they would be making payment in 90 days, and both parties agree to that, then and one of the supplier party is MSME. So whether this provision would apply. And it's now quite clear, and after a lot of debate, this has been made very clear that this would apply, that mutual consent cannot alter the provision of the Act, which is Section 15. So there, Section 22, if not paid, then Section 22 gets triggered, and that has to be provided for. So this again has to be known to a auditor when he is auditing whether any MSME trade payable has not been paid on time, whether this liability which is emerging from Section see 22, whether that has been provided for in the books or not. And of course, he has to see the materiality aspect also. But this is another example of other laws and regulations. Let's look at the third example. And again, this is again a very interesting scenario comes here. You must have seen that there are various laws, labor laws, which are now since has already been applicable from July 2022. And I would just like to, and then all these have specific provisions with regard to how a particular expenditure has to be incurred. I mean, 2-3 examples I can give, which will help you to understand the importance of these labor laws, how they are really making a material, may result into material misstatement of in financial statement. For example, a company has employed a very large number of employees, and their working conditions are such, and then they have to provide for bonuses. Then this if they have work for additional time, then overtime has to be provided for in a particular manner. Then bonus has to be provided for. Provident fund requires that provident fund deduction and contribution has to be, and similarly, Employee State Insurance Act also talks about the contribution to Employee State Insurance Fund that has to be provided for. So very large number of cases we have seen that there are non-compliances of these acts by some of the corporates, and some qualifications are also appearing, but and sometimes these are very have a very large, major, or I would say very direct impact on material impact on the financial statement also. And especially when this some new case laws sometime comes that, for example, now if Provident Fund and ASI dues are not paid by the company on time, so under the Income Tax Act, they are saying that the not only the employees contribution, even employers contribution will not be allowed an expense. So that will have a direct impact on the income tax liability, which has to be provided for in the financial statement. So this is the way how it is impacting, having a material misstatement with on the financial statement. So from that point of view, you can see that. So one more example I would like to give is with regard to the FEMA rules and regulations. Here also, you can see that if a company is dealing in foreign exchange, whether by way of import, exports, or they have any borrowings or lendings from outside India, if they have their place of businesses outside India, if they have foreign investments, if they have made investment overseas, how those are to be dealt with, what are the provisions, what are the permissions, and how those can be done, to what extent those can be done. These are all provided in various regulations. And if those regulations or rules are not actually followed, there are repercussions, there are penalties, and compounding fees and all those are applicable. So, I mean, and then sometimes those liabilities are so high, and sometimes not only high, in some cases, those transactions have to be reversed. I mean, a quick example, I could say that if, let's say, a foreign investment company where there is a foreign investment, they cannot invest in agricultural land. There are a number of cases I have dealt with where companies have invested in agricultural land. So the entire business of the company was actually based on defaults or on the non-compliance. So which cannot be done and has to be reversed as per the regulation. So the money has to go back and all. So say some of these provisions have very serious repercussions on the working, as well as have, for example, in the non-compliance under Foreign Exchange Management Act, there is a provision for penalty of 3 times of the amount involved. So you can see how much, and there is, of course, there is a provision for compounding, but that is only once you go to the compounding. But now, 3 times of the amount default, you have no choice as an auditor to ensure that the company has either shown that or provided for that, or whatever those repercussions which result from non-compliances of various provisions. So these are some of the examples which I would say that can give you a hint that how other laws and regulations are really important. So as we all in virtually the entire audit, we say that the primary responsibility of compliances with laws and regulations is that of the management. Yes, that applies here also. So management and those charged with the governance, they have to ensure that the entity operates as per and in accordance with various provisions of laws and regulations which are applicable to them. And then they are also supposed to determine the report amounts and disclosure in entity financial statement if there is any non-compliance. And because non-compliances may result into penalties. So in case there's a non-compliance, so that amount is also required. So that is the entire responsibility of the management for compliances. And how they actually do this? I mean, if we understand, or rather, I would say, when we looking at the going for an audit, we can see that how they have done it. So typically, we have seen that companies which are good companies, they have a policies or SOPs in place that first of all, they identify what are those significant laws and regulations which are applicable to them. So that is one document which, as an auditor, we must see when we see even framing our audit program or while discussing with the client. Then companies also do, and first of all, they maintain these type of registers. Then secondly, then further frame code of conduct that how each and every law and regulation will be complied with by the company. So because law applicability is one, then how to comply with that. So those, and then it also have some kind of a, this code of conduct will have that how employee is going to do, what is do and don'ts come under this code of conduct. So they develop it, they publicize within the entity, and they require everyone to follow that. Then third step we have seen in companies is that each employee or are they are trained, they are exposed that suppose a particular person is, let's say, dealing in GST matters or income tax matters. So they are trained that how you should be ensuring that there is a no non-compliance happening in your domain. So, and similarly with regard to labor laws, with regard to other which we have just explained, I just explained 4 or 5 examples. There can be more such examples. And then there has to be some kind of a monitoring mechanism within the company that whether that code of conduct which has been set up and which has been for training has been employees has been trained for that, whether that has been being complied with. And for that purpose, we have seen some of the companies are engaging legal advisor to assist in monitoring legal requirements. And one of such a very recent one is you must have heard about POSH, prevention of on harassment on working place. So there we have seen a lot of legal firms now coming and they are advising corporates how to really ensure that these particular act is properly adhered. All the provisions are adhered to by the companies, and there is no non-compliance. And if there isn't any non-compliance, how that has to be dealt with. So it means sometimes legal advisors also assist, and we have seen that in the case of very common are in tax matters, in whether it's direct tax or indirect tax. Companies do take legal advice in monitoring legal requirements with regard to that. So that is what I'm trying to say, that primary responsibility is that of the management. And these actions, which I have just mentioned, 5, 6 actions, that depicts how company is actually, the management is ensuring compliance with laws and regulations. And sometimes in larger entities, they top up those steps which they have taken with two more levels. One is they may appoint or they put in place an internal audit function, and within the internal audit function there is a mandate for internal auditor to ensure that whether all the laws and regulations are complied with. And very frequently we have seen, especially in the case of listed companies, audit committees have a clear-cut mandate and to ensure that all the policies and procedures, all the of various laws which are applicable to the entity are complied with. And we have seen that in most of the time, audit committees insist that the respective head of function of a particular area comes and gives a presentation to the audit committee. What are the regulations and how they have been complied with? Is there any non-compliance? And if there is, how they are going to tackle it? All those parts. So audit committee also takes a lot of responsibility with, from the management side to ensure that there is a compliance of laws and regulations. So from auditor's point of view, these two aspects, how management is ensuring and how internal audit or audit committee. So their minutes and their audit committee reports, internal audit reports will help you to make an assessment. First of all, to also make your list that what are the laws and regulations which are applicable. Sometimes you may not visualize, but it is applicable to that particular company. And from my personal experience in one such company, I was not aware it was purely a trading company, warehousing company, but uh, some kind of a exclusive act was applicable to them. And under that act, if you have not complied with, there was a heavy penalty. So this is just one example. This came to my mind. So and that I could see from the minutes of the audit committee meeting. So there it was mentioned that a presentation was made by on fire and explosive side also, and there were non-compliances. So in fact, the point was raised whether that penalty is going to be there and whether company should make provision for that liability in the financial statement. So that is the point which we have to keep in mind when we are auditing from it. So now let's look at how auditors are responsible for non-compliance of other laws and regulations which are applicable to that particular entity. First of all, as I mentioned to you, we have to see that non-compliance should result in a material misstatement. And material misstatement is again a very subjective matter, and it depends on your on case-to-case basis. You would determine the materiality line, and then based on that, you will determine whether that particular non-compliance has resulted into any material misstatement. And so here a lot of issue has been raised, and auditors have said that we are not legal expert who can determine that whether this non-compliance would result into something serious or any material misstatement, or so in that situation, we have the auditor has no choice but to ask for professional help in this respect. A quick example I can give you is that there was one particular company which has set up its plant in a particular area. At a later stage, it was found that that area is banned for any industrial activity. So under a particular law. So the implication of that, how that is going to be, whether that company is going to be, that entire plant is going to be shifted from there, and how that shifting or it can be regularized by paying some fees, or what is the financial implication, and whether that has a material misstatement, because then if it is it goes into shifting, then a lot of loss of production, loss of business will be there, and of course it will also involve cost. So these type of material misstatement, this type of impact can be material, and if not considered properly, may result into misstatement of financial statement. So their responsibility to the auditor is to take external help, professional help in this regard to determine that. And another point which is important is that sometime we have to be very careful also that whether as an auditor we have expertise to deal with that particular subject at all. And some of the industry are highly technical. For example, if we let's take the case of this telecom business. Let's take the case of maybe some other business of similar, which has a very peculiar, you see, or even I would say, why go so high? Even the business of, let's say, dealing in stock markets. These are specialized, businesses, and requires a study of very detailed business guidelines, business laws and regulations. And if not complied with, then a lot of issues come up. It may be in the shape of non-compliance with regard to even insider trading, or even exceeding limits, and doing some business which is otherwise prohibited, and all those aspects. So if we are not conversant with the nitty-gritties of that particular law and regulation within the framework of which the entity operates, I think we should sometime also consider not accepting that assignment. Or if you feel that that's extreme, nobody is going to do that, then first of all, develop that expertise, or take help of experts to to ensure that you have domain knowledge of the particular laws and regulation in which that entity operates. Even that like there are new businesses like toll, where there is a different models which are operating. So one should understand how that business is to be taken care of, how income will be recognized, what are the provisions which are required to be made, all those. So point which I am trying to say, that auditor, even before going into the examining non-compliance or looking into the laws and regulations, first must understand that what are those laws and regulations, and are you comfortable with, are you fully, I would say, at least not fully, or I'd say not as an expert, but at least you know that which are the major compliances which are required under those laws and regulations. And because once you know, only then you can do justice to that particular audit assignment. It is very clearly mentioned, and say maybe a saving grace, that auditor is not responsible for preventing non-compliance and cannot be expected to detect non-compliance with all laws and regulations. So they say, I personally may not be agreeing with the later part of it, which says cannot be expected to detect non-compliance with all laws and regulations. Frankly speaking, the way these days law enforcing agencies are examining non-compliance with other laws and regulations is expected from auditors. So that's though the literature says so, that cannot be expected. But I personally feel that the expectations are a little different on that. Anyhow, we can debate that further. Then see, first is that when we are talking about the responsibility of the auditors, the first was to determine and to to identify what are those, first of all, what are those laws and regulations which are applicable, and are there any non-compliances which has a material, which can impact material, which can result into material misstatement in financial statements. And after that, the next step is the reporting aspect. In accordance with the specific statutory requirements, the auditor may be specifically required to report as part of the audit of financial statement on whether the entity complies with certain provisions. So that is one part where specifically, I'll give you some examples of that. So that is first part, specifically reporting on those statutory requirements. Then second is where there are specific statutory requirements, it may be necessary for the audit plan to include, of course, that we have no choice. In some audit engagement, especially those relating to audit of government ventures and tracking, there may be additional audit responsibilities with respect to the consideration of laws and regulations, which may relate to the audit of a financial statement and may extend to other aspects of the entity's operations. I mean, we have seen in some of the cases, they even talk about the performance audit also. So those aspects are also covered in some of the audits. That's a different, but that responsibility, once it is there, that has to be complied with by the auditors. Now, some of the examples of reporting, we can see the reflections in Companies Auditors Report Order 2020, that is CARO. You can see here that in para 3, in 1E itself, they are talking about these particular para relates to whether is there any proceedings going on with regard to holding of any Benami property under the Benami Transaction Prohibition Act 1988. So this is so it means you must know that what are these Benami Transaction Prohibition Act, and accordingly only you can report. Of course, the company would definitely be giving in the financial statement itself by way of notes whether any proceeding is pending or is going on. But in addition to that, you have to have some audit procedures to establish that whatever statement has been given by the management is correct, and there is no so those additional steps or checkings or has to be taken care of by you. Similarly, there is another in the CARO itself. You can see that there's a very detailed information required on in para 3, this point number 7A and B, where it is talking about that whether the company has deposited undisputed statutory dues, which includes GST, Provident Fund, ESI, income tax, custom duty, then any other value-added tax, cess, or any other statutory dues to the appropriate authorities. So it means that some of them they have specifically mentioned GST, income tax, provident fund, and employee, but some of them say other statutory dues to the appropriate authorities. So other statutory dues again has to be visualized from the point that what are those statutory provisions which are applicable, and what are the dues which are payable by the company. Have they been paid? Are there any arrears? And when if there's a more than 6 months, so they have to be disclosed the amount also. And similarly, if there's any dispute going on, that with regard to disputed, they have to be disclose the amount and the level at the stage at which they are stuck, or at which they are being contested. That is also required to be given. So this is the reporting part of it. Similarly, this is another very interesting provision which has been brought in by the CARO 2020, and that is regarding transactions not recorded in books but have been surrendered or disclosed as income in tax assessment under the Income Tax Act. Because this is what was happening, that number of times when tax assessments happen, companies used to are surrendering some asset, some income as their undisclosed asset or undisclosed income. So what happened after they have been taxed, how that asset or income has been or even has been brought into the books of accounts, even that disclosure is required. So it is a non-compliance, and then reporting by the auditors. So similarly, you can also see there's in Caro itself, there's a reporting with regard to, see, under the SEBI Act, there's if the company has raised certain money through IPO or FPO in the case of so whatever purpose has been mentioned in that particular red herring prospectus, that for which the money is being raised, whether that application, the money has been applied for that same purpose, that is again a very specific requirement of SEBI regulations, which auditor is required to report. So we must know what are those provisions. And similarly, you can see a very detailed information is also there with regard to Nidhi company, as well as relating to RBI. Whether it's a Nidhi company, then all the specific parameters which are applicable to Nidhi company, whether they have been complied with. Similarly, in the case of a non-bank, whether in the case another requirement is that whether the company requires 45 under section 45A of the RBI Act, and if so, whether the registration has been obtained. See, now this is a very interesting reporting requirement, and I fear that lot of auditors are not making a proper reporting under this particular requirement, because you see the requirement is whether the company is required to be registered. So now what are those requirements? So those are there in section 45 IA of the RBI Act, and then we have to examine those, whether those conditions are complied with or not. If those criteria are met, and if company is required to take the permission or take registration with RBI, so anything which is done without RBI approval will become like a ultra virus, and auditors has to accordingly report. It's a very serious kind of reporting requirement. And similarly, in the case of housing finance companies, and they are also like in any other NBFC. And there is another concept of core investment company. Sometime whether those criteria are met before it is being treated that it is a core investment company. Those are all provisions which initially I also mentioned, that there are certain specific directions which has been issued by the Department of Non-Banking Supervision and accordingly have to be complied with. So auditors, while reporting this, has to be very, very careful. And these are some reporting requirement which emerged from the Companies Act reporting requirement. We are just talking about, if you look at these two slides, these were reporting requirement statutorily required by auditors to report. Here we have no choice but to report. Now, these were under the Companies Act. Now, see, some other acts also mandate that that auditor should be submitting a report with regard to compliance or non-compliance of the specific laws and regulations which are applicable to that company. For example, you can now understand this particular slide. For example, in the case of non-banking financial companies, there is a direction called Auditors Report Reserve Bank Directions 2016. Very specific, separate set of directions are there which are applicable to auditors of the NBFC companies. So these directions require that auditor will submit an additional report to the board of directors. And there are certain matters, very detailed, around 15, 16 matters which are there. And then that has to be reported to the board of directors. And if there is a non-compliance, specific non-compliances, then auditor is also required to submit a exceptional report to the Reserve Bank of India. In this, so there it is talking about registration aspect, deposits, and non-deposit taking, various directions. If it's a deposit taking, whether those are within the limit, whether all the compliances have been made, and in the case of non-deposit, whether the provisioning norms and all those are, whether returns have been filed properly, and other registrations with other regulatory mechanisms like FIU, and maybe in some cases with the with regard to the properties which are against which the loans has been taken. So those are also required to be reported to a particular authority. So all those reporting requirements, then registration with the various rating agencies. These are the requirements which are applicable to non-banking financial companies. And if they have not been complied with, then as a auditor under SA 250, we are not only supposed to look at their impact on material misstatement in financial statement, but also required to report not only to the shareholders or to the members through the audit report, but also to a regulatory authority through specific directions, as I just mentioned, Auditors Report, Reserve Bank Directions 2016. Now, these were the point till this time, this space we have discussed are the general discussion with regard to, say, SA 250. Now, let us come to some of the, specific requirements of SA 250. First of all, to summarize these 2-3 points which I want to summarize, and these are very important. First, it says that, but you can summarize that this essay distinguishes the auditor responsibility in relation to compliance with two different categories of laws and regulations. These two different categories are, one, which are the laws and regulation within the framework of which the company operates, and other laws and regulations. So first category is, in the case of first category, the auditor responsibility is to obtain sufficient of appropriate audit evidence about compliance. For other category, the auditor responsibility is limited to undertaking specified audit procedures to help identify non-compliance, and that may have a material effect on the financial statement. Okay, so now you can see here the distinction. The first category is there, the material effect on a financial statement line is not there. So, for example, as I mentioned to you, if a company which is supposed to take registration from RBI to carry on any NBFC activity. For example, let's take a case, a company has a particular amount of capital which they have inducted, and they are investing in the share market. So they may take a ground that this is all our money, we have not borrowed, we have not taken from any third party or all that. This is all shareholders' money, and we are, but still, as per the requirement, they are supposed to take RBI registration to carry out investment activities. So first category says that if there is a non-compliance, then auditor's responsibility is to report them. Second, in the other categories, the reporting requirement comes only when they have a material effect on financial statement. So this distinction of two different categories of laws is very, very important. And then I'll explain you some through some examples. Let's first come to the first category of laws and regulations. Ruchiji, do we have any question in between?
We have a couple of questions, but I think I'll wait till the end so that we can capture all of them, if that's okay, or you want me to ask?
No, it's okay. It's okay with me. I thought sometime if there's any pressing point which I want to explain.
No, sir, we'll just do it together.
Okay, no problem. So, so first categories of laws and regulations. It has a direct effect on determination of material amount and disclosure in the financial statement, such as tax and labor laws. They could include those that relate to the form and content. Now, in the case of first categories of law, you have to see four basic aspects of that non-compliance. The form and content of financial statement. For example, as I mentioned, that let's say in the case of a electricity company, how they have presented the financial statement. Are they as per the specific format which has been prescribed under the Electricity Act, or it is in a different format? Then industry specific financial reporting issues. So for example, in the case of a banking regulation act, there are some specific reporting issues are there, whether they have been done or not. Accounting for transaction under government contracts, of course, this is another. And accrual or recognition expenses for income tax on retirement or retirement benefits. Here are some of the examples which I have just mentioned, that in the case of tax laws and labor laws are these are important one because they have a direct impact on material misstatement. Some matters may be relevant to specific assertion, and there can be an example of completeness of income tax provision. As I think I gave you an example earlier also, that it has like PF and ESI payments not made on due dates. So it means that though they have been paid, so from accounting point of view, payments have been made, and even interest has been paid, whatever interest was due on that. But since those are not allowed as a business expense while computing the tax liability, so whether they have been considered while making the income tax provision, that is a relevant point which I want to mention it here. While other may be relevant to the financial statement as a whole. For example, there is a required statement constituting a complete set of financial statement. So these maybe we can say that these are the first category. And in the case of a first category, what are our responsibilities as an auditor? The auditor responsibility is to obtain sufficient appropriate audit evidence about compliance with the provision of those laws and regulations, to respond appropriately to non-compliance or suspected non-compliance with laws and regulations identified during the audit. See, again, since what the word mentioned is suspected non-compliance with laws and regulations. Now here, by way of an example, I would like to draw your attention to see section 143 itself, where there is a reporting requirement with regard to fraud. And if you look at the fraud definition under section 447, there is a suspected fraud also, which is required to be reported. So suspected non-compliance with laws and regulations identified during the year. Because why the word suspected has been used here is because of this fact also, that sometime we are not expert to give a final verdict that there is definitely a non-compliance, but we suspect that there is a likely that there are non-compliances. So from that point of view, even those reporting requirement sometime are there. One example I have given you, and there are some other examples also on that. Now, second category is category of laws and regulations. First of all, do not have a direct effect on the determination of the amount and disclosure in the financial statement, but compliance with which may be fundamental to the operating aspect of the business, to an entity's ability to continue its business, or to avoid material penalties. Non-compliance with such law may therefore have a material effect on the financial statement. See, now you can see here how important that category is. So the example which I gave was about operating without license, or operating in a area which is not permitted to operate from there. And in number of such another cases, type of cases which are coming up is operating without any clearance from pollution control board. Effluent treatment plants are not there, and companies are. So those are sometimes which result into material penalties, or sometimes closure of business also. So those are another category where non-compliance of particular laws and regulations have to be seen seriously. So what we are trying to say here, non-compliance with the law and regulation that have a fundamental effect on the operation of the entity may cause the entity to cease operation or call into question the entity's continuance as a going concern. So this is, for example, licenses, I just mentioned to you about it. Banking company, which is or operating without even non-banking company, financial company is operating without capital and the basic minimum capital investment requirements. So they are not supposed to work. They are not allowed to work. And then if they do, the very existence comes into question. There are other many laws relating principally to the operating aspect of the entity that typically do not affect the financial statement and are not captured by the entity's information system relevant to financial reporting. So these are second type of laws and regulations. So so what it is trying to say that in financial statement, first of all, they do not materially or substantially impact them, or neither they are captured. One simple example which can come to your mind maybe is non-registration under Shop and Establishment Act. Suppose a company. So though if you look at the particular act, you will see that it has some implications, may not be material but from the financial statement point of view, it has no, they are not captured in the entity's information system relevant to financial reporting. So those are also to be, auditor must understand those and then take a call how to really go ahead with that. So in such situations, when he has seen this second category of laws and regulations that do not have a direct effect on determination of the amount and disclosure in the financial statement. Here, then how auditor is going to, first of all, identify them. So they have to do some specific audit procedures. As I mentioned to you, in some cases, from the management or those charged with the governance or even the audit committee, a list has to be seen, has to be taken, how they have to, what are those laws which are applicable, and then assess whether they have any material effect on the financial statement. Now, whatever I have just discussed. Let us now bring into a capsuled form. Now you can see that SA 250, you can summarize that into 6 major steps. The very first step is auditor's consideration of compliance with laws and regulations. We will once again we'll go through some of these paragraphs with examples. So first, auditor's consideration of compliance with laws and regulations. Then audit procedure when non-compliance is identified or suspected. Third, reporting of identified or suspected non-compliance to those charged with the governance, and creating or keeping all the documentation part of it. Then taking a call how to really report them in auditor's report on the financial statement if you decide that it has a material effect on material misstatement, may result into material misstatement. And finally, reporting non-compliance to regulatory and enforcement authorities. As I mentioned to you about the, 143.12, any reporting to ministry, to the government. And those are some of the example point which has to be. So these 6 points. Now let's look at some of, all these points in little more detail. So the auditor's consideration of compliance with laws and regulations. As part of obtaining an understanding and its environment in accordance with SA 315, the auditor shall obtain a general understanding of legal and regulatory framework applicable to the entity and industry and sector in which the entity operates, and how the entity is complying with that framework. You see, why I am telling you this again is that while you complete an audit, your audit documentation should cover all these points without fail. So maybe these aspects can be brought in or maybe put into your audit program itself, that first of all, asking or even observing what are the legal and regulatory framework applicable to the entity and the industry or sector in which the entity. So right from the sector, industry and entity level, it has to be seen. And then obtaining an understanding and creating audit evidence with you, how the entity is complying with that particular framework. So I think example which I have already given you, for example, if a company is a banking company, or is an insurance company, or is a electricity company, then what are the framework in which it operates, those regulators, what are the frameworks which they have set up. And so identifying those regulatory framework and putting into place a documenting that how the entity is complying with that. So and another step in the same direction can be the auditor shall obtain sufficient audit evidence regarding compliance with the provisional law, generally recognized to have a direct effect on the determination of material amount. So while looking into the second point, how the entity is complying with that framework, at that time you would also be taking care of or looking into this aspect, that how if there is a non-compliance, whether that non-compliance has any resulting into any material amount or any resulting into any disclosure requirement in the financial statement. So that is the another sub part of that first point itself. Similarly, the auditor shall perform certain procedures to help identify instances of non-compliance with other laws and regulation that may have a. So inquiring the management, those charged the governance, and whether they compliance with such laws and regulation, inspecting correspondence, if any, with the relevant licensing and regulatory authorities. So this is how you are going to see this, how the entity is complying with that framework. So these are the steps which are required to be taken to comply with that particular aspect. And two more points can be seen when we say that during the audit, the auditor shall remain alert to the possibility that other audit procedures apply may bring instances of non-compliance or suspected non-compliance with laws and regulations to the auditor's attention. How this can happen? While reading the minutes of the board or maybe even the general meeting, you may find something. Inquiring of the entity's management and in-house legal counsel or external legal counsel concerning litigation, claims, and assessment, performing substantive test of details of class of transaction, account balances, and disclosure. So you can see here there are three primary ways to see to audit procedures, which can be reading minutes is quite clear that I can give you one example. In a practical example, I was going through a particular audit. When I was going through the minutes of a board meeting, I found that in a particular board meeting, they approved a particular type of activity which they want to carry on. So, and when I related it back to the financial statement, I found that the activity has generated a lot of revenue to the company in that particular year, and it was not there earlier. So then it led me to look at the object clause of the company. So then I saw that those objects was not there. So when I made an inquiry why this activity has been done without the when the object clause is not there, so then explanation was given that we have amended the article, the memorandum subsequently. So till the time it was subsequently amended, the activities were ultra virus. So I had no choice but to report that in my auditor's report. So this is, I mean, I'm giving you a very practical example, though it was very tough to give that kind of reporting, but sometime it happens. Another example, performing substantive test of details of class of transactions, account balance, and disclosure. Very good example can be, there was a company which has a lot of international trade payables and trade receivables also. So while she performing tests on those, asking for confirmations and all that, it was noticed that some of the trade receivables are outstanding for more than 1 year or even 2 years. So the next question was that how you have complied with the requirement of under FEMA, which requires that a permission has to be taken from the bank for extending this period of recovery. So there was no approval was taken, and accordingly and looking into the amount materiality of that non-compliance, accordingly a decision was taken how to really report that. So this type of examples can be there, and of course another very interesting example which most of the people know also, and then is a one good way of finding it, is when you scrutinize legal and professional charges, sometime when you see that a very substantial fees has been paid to a particular lawyer, then you ask what are the cases which are pending, and then sometime you find that the particular council is actually fighting a case for non-compliance of a particular law, which in fact didn't come to your notice otherwise. And then you ask what are the financial implication of that, and how they have to be dealt with in the financial statement. So that that leads to the next level, where you ask for the materiality aspect of it and determine how to really go about it on the reporting part of it. Then inquiry from management. And sometimes these inquiries, I have seen that, sorry, okay. And finally, on that, the auditor shall request management and those charged with the governance to provide a written representation that all known instances of non-compliance or suspected non-compliance whose effect shall be considered when preparing have been disclosed to the auditors. However, written representation do not provide, as it is, I think, a right para of caution, that simply don't rely on the just a written representation letter from the management. You have to do some extra verification on that aspect, and those points has already been mentioned. Read minutes, make some inquiry from looking into their litigation aspect, and of course perform substantive test of class of transactions, which may give you that whatever statement has been representation has been given by the management is correct. Let's come to the second leg of the points which I just mentioned. Audit procedures when non-compliance is identified or suspected. First, we have identified that you have done some work, how to identify. Now you have identified what is to be done now. There's a second step is, logical step is, okay, now what? Audit procedure when non-compliance is identified and suspected. What is next? So now once you have aware of information concerning an instance of non-compliance or suspected non-compliance, then you would further look into, okay, what is that non-compliance, under what circumstances that has happened, and what is the possible effect on financial statement. Very logical, because all non-compliances of laws and other laws and regulations are not always result into financial impact on the of the entity. I mean, material misstatement may not be there because of that. So determine that. So next step is to understand the nature of act. As I given you an example, for the example which I gave, let's say in the case of a, you see, receivables, and then it is also, I mean, I can give you another very interesting example, practical example, which led me to to detect a particular suspected fraud also. So what was happening that when we look at the receivables, in the meantime, there was a notice from ED to that company that lot of pending invoices are pending with the bank, for which payments have not been received. So when we asked for the detail of that particular information, so that information was not reconciling with the receivables which are appearing in the books of accounts. So then we wrote to the management, explain us what is the reason why the receivables which are being reported by the bank through ED are not matching with their books of accounts. So then they gave an explanation that certain amounts has been adjusted, received in different company, and so many other explanations came up. So which virtually result we could see determine that they have really messed up, and somewhere it was intentional also. Anyhow, that's just a one point. It's how when you suspect, when you have now suspect that there is a non-compliance, when you look into the circumstances in which it has occurred, and sometime it will give you a very different picture, and that picture itself, once you understand, will give you the possible effect of those non-compliances on the financial statement. And then whenever you have any, the SA 250 also requires you that whenever there is a suspected non-compliances, the auditor is required to write to the management and ask for their their explanation on that. So their explanation will always be a very important to understand what has happened. In fact, it also creates a good audit evidence in your file that how they have been, how they are being treating this particular non-compliance, and are they even aware of that non-compliance? Is there intentional non-compliance or unintentional? Of course, it doesn't make much difference, but at least the fraud aspect, sometime if it is intentional, then you have to really examine that also. So then whatever, if management or in case if you have written to the those charged with the governance, they do not provide sufficient information that support their whether they have complied with or not, then it is your call to see to look into it, and once again go into the detail whether it has got any non-compliance. Sorry, it has this non-compliance has any material impact on the financial statements, and then accordingly you may even take legal advice on that and go further on that. Lack of and sometime see, we may even go to giving some kind of a disclaimer or qualification as you take appropriately. You can see that first of all, understand the non-compliance, take the explanation from them if you are not satisfied, and if you are not in a position to to take to finally make a assessment its impact on material on the misstatement, then you may qualify your opinion, or you may give a disclaimer on those aspects. So auditor shall evaluate the implication, including the auditor's risk assessment, reliability of written representative, and take up. That's fine. Okay. Now let me give you some. This is, if you can look at this particular slide. I have listed down certain as indicators, as in normally bank audits we always say early warning signal, EWS. So similarly for SA 250, you can treat them as EWS or maybe indicator that non-compliance is with law. So some of the examples, these again, now you can see investigation by regulatory organizations and government departments, or payment or fines and penalties. So that is simple. When you look into this, is there any investigation going on? Has been investigated? What are their observations? And whether any fines and penalties have been. So we have seen in a number of cases, especially GST is one such case where a lot of this type of observations has been seen. Unusual payments towards legal and retainership fees. This again, so it means there's something going on for which a company is fighting and paying legal fees to the consuls. Unusual transaction with companies registered in tax havens. Adverse media comments. This again now these days has become very, very important. Let me give you one very interesting example. There was a media report in one of company's case where the managing director of that particular company was talking to a reporter, and he mentioned that his company has achieved so much turnover, and the top line has crossed this, and bottom line is so much, and all those. And he has operations at 4 places, 5 places in the world. So this, his comments were actually somebody, an auditor saw that, and he noted down that these are the figures which he has quoted. So through a representation, he asked the management to explain why all these things are not matching with the financial statements. So why the turnover is not so much, why the profit is not so much, why the operations in different locations are not being reflected in financial statements. Now you can imagine that if these were different, so what kind of observations would have come? So the point which I am trying to mention here is these days, even sometimes these media comments are also important, or this is one side. Second is a number of litigations. There are so many sites which are actually putting up this type of data. What are the litigations which are pending against company or directors of listed companies? So sometime you can also go through that and find out is there any adverse media comments, and then expose them to the management or those charged with the governance, and ask for explanation for that. And then you can decide, are you satisfied or you want to go further on that. So payment for unspecified services or loans to consultants, related parties, employees or government employees, again indication. Payments without proper exchange control documentation. This I have also, it's not only payment, sometimes even receipt of money against from third party towards the receivable from a particular party. So sometimes those are also creating a situation where non-compliance or was observed. So you can also look into that. Existence of an information system which fails, whether by design or by accident, to provide an adequate audit trail or sufficient evidence. Again, practical part of it. Unauthorized transaction or improperly recorded transactions. A number of times they'll say, okay, we will provide you information on that particular transaction. And till audit is complete, they are virtually don't provide you much. So again, those are all identified as the indicator of non-compliance with laws and regulations, and has to be dealt with accordingly. So these were the matters which I mentioned, that there is an indication. And once the indication is there, then how auditor is going to evaluate the possible effect on the financial statement. The potential financial consequence of non-compliance with laws and regulations include the imposition of fines, penalties, damages, threat to expropriation of asset, enforced discontinuing of operation, and litigation. Whether the potential financial consequences require disclosure, that is another important point. Whether the potential financial consequences are so serious as to call into question of the fair representation of the financial statement or otherwise make the financial statement misleading. As I mentioned to you, sometimes on the going concern itself, it has some implication. So from that point of view, sometimes this kind of serious aspect can also appear. Now, coming to the third point, reporting of identified or suspected non-compliance. So first, we have seen that auditors consideration of compliance. Second is if when non-compliance is identified, then what are the steps to be taken by the auditors. Now, third is the once you have even determined that it has a material misstatement aspect is there, then how to report them. So
Anil sir, just a quick reminder.
yeah.
We have just a time check basically. We've got 15 minutes more and we have questions also.
So okay,
I'm not asking you to rush. I am not asking you to rush, but I'm just being cognizant.
No problem, no problem. But I'll do another maybe maximum by 5 minutes. I will conclude this so that we can devote more time on the questions.
Sure, sir.
Okay, so I think now what we can do is, as I mentioned that before reporting, auditor will discuss the findings with the management and the charge with the governance, and then if they provide any additional audit evidence, then accordingly the auditor will decide whether to report and how to report and what is to be done with that. Then if the auditor's judgment, the non-compliance is believed to be intentional or material, the auditor shall communicate the matter to from management, it will move to the next level, which is those charged with the governance. And then, of course, they can also even go to the audit committee and the board of the company also and take a call on that. And if he find that even management and those charged with the governance themselves are involved, then of course, as I mentioned, audit committee or even board can be also be contacted. Fourth aspect was the documentation part. So all the three steps which has been which I just mentioned about auditors' consideration of compliance, procedure when non-compliance is identified, and then the third one is communication with the management, those charged with the governance, with the audit committee or even the board. That all that has to be documented and should be part of the audit file. And related records or documents based on which that suspected non-compliance was identified has to be kept as part of the audit papers. And then if there is any discussion has happened on that topic with the management, then that is also required to be reported. Reporting of non-compliance in the financial statement. So then once you are reporting, then you can look into SA 705, whether to give any qualified or adverse opinion and accordingly take a call. That is purely auditor's prerogative, how he wants to deal with that, want to give any qualification or an adverse. So SA 705 in a very detailed manner explains when to give a qualified report or when to give an adverse opinion. So I don't want to go into that at this moment. And finally, non-compliance reporting or non-compliance. Finally to the enforcement authorities or regulatory authorities, as if there's any suspected non-compliance and auditors feel that there is some it requires to be reported also because of any fraud angle, so then they may have to report accordingly. I mentioned about 143.12 also in that. So that is the one. Now just quickly, last point I would like to say that though SA 250 is there, and which as an auditor we have to comply with, it's a mandatory to comply with that. But very interestingly, we also have now our code of ethics. Section 360 of the code of ethics deals with non-compliance with laws and regulations. No CLAR. We are fully conversant with that. So from code of ethics point of view also, the non-compliance with laws and regulations has a lot of importance. Of course, for the time being, there is this particular section, which is section 360, is applicable to audit engagement of entities, the shares of which are listed and having net worth of 250 crores or more. So in those cases, this no CLAR, which is the from code of ethics point of view, has also become applicable and has to be complied with along with the SA 250. So, Ruchi, I think I'll stop here and then let's take questions.
Thank you, Anil sir. Actually, I'm sorry if I had to push you.
No, it was, I think I have to devote at least 10-15 minutes for the questions. Yeah.
No problem, sir. So I'm just we've got a couple of questions and I also have one or two. So I am going to just start with the questions that I got first, or maybe I'll just mix all of those questions. So one question was, and I think you mentioned that in some cases there could be companies which have overseas subsidiaries, or they may have operations in international locations. So is the auditor really required to review the compliances or the laws pertaining to each and every country which is there and then report? Or what should be the view of the auditor in this case?
Yeah, I think you have touched the SS 600, which is the now you have to see how NAFRA is behaving on. I mean, they have issued a notification on that as a auditor of the holding company, the auditor has a responsibility to look at the financial statement of subsidiaries and associates also, because CFS is an important document. It has virtually all the importance as to the standalone. So, and I'm sure SA 600, the way in NAFRA has interpreted, we have no choice but to look at that. So so the crux of the matter is that now, I mean, of course, they have simply issued a notification. So it is not that they have clarified it. So it means it was applicable right from the beginning. It's not that something new. They are now trying to explain. So they are saying that as a auditor of a CFS, and so he is also responsible to ensure the compliances of the entire audit standards of the component entities also. So taking clue from there, I would say that since SA 250 is also required to be seen on the CFS, so that same logic would apply, and the auditor of the consolidated financial statement would be looking into laws and regulations which are applicable to subsidiary companies, and if they are overseas, then those are also required to be seen.
Right. I agree, and I think you have even mentioned similarly in your starting section also that all relevant laws and compliances, whether it is the location or anything, will have to be considered. So yeah, moving on to the next question, sir, that says that if statutory dues are not paid by any of the company, and then as an auditor, when a report or a CARO report is done, would such a disclosure of fact in the CARO report be construed as a qualification or an adverse remark?
Yeah,
I know you practically answered
First
that.
of all, see, if you look at the guidance note which has been issued with respect to CARO, So at the end, it is very clearly mentioned that this is a very specific reporting. But if any of the reporting has any impact on the true and fair, on the state of affairs, as well as on the operations of the results of the company, then the same has to be reported in the main report also. So that I think hopefully it will give the answer that whatever Caro, those are specific reporting requirement. But
Right.
we cannot say that in Caro we have given a very serious kind of reporting and has not reported in the main report if it has a implication on. For example, let's take a case that company has company has not deducted tax at source on, let's say, very heavy amount, and neither it has deducted nor provided for, not and then there's a lot of delay. This has been reported in Caro, right? But now look at the impact of that. So had they deducted, then interest would have been paid. Then non-compliance has come some penalties which department can impose, and even there is a provision for imprisonment in high value defaults in the case of non-deduction of tax. So that aspect cannot be ignored in the main report. So statutory dues to that extent has some implication, and if it has a direct implication or impact on the true and fair view, then those has to come on the main report also. I mean, of course, you can see, give a reference that it was already reported there also. The same reference can be there.
Thanks, sir. Next question is like, if the auditor, while doing all his, auditing activities, and bases all the work that he has done, he has not been able to identify any of the, non-compliance or, it was not basis reasonable account auditing practices. He was not able to identify, and then it was disclosed later. Then will the auditor be responsible for it after?
Yeah, auditor has to really convince at a later stage that how the compliance of SA 250 was seen by him. So 5 steps which we just mentioned. Has he first of all review the industry in which it operates? What are the laws? I mean, generally, has he studied that? Is there any document in his file which shows that he has studied this? Second, has he communicated with the taken some kind of a confirmation from the management charged with those with the charge with the governance that there is all the laws and regulations which are applicable to the company has been complied with, and non-compliance has been reported to the auditor. This type of specific, and then what are the steps which he has taken to ensure to verify that. But so that should be reflected on his audit papers. If those are there, then there is no problem. But if he is not able to prove that, then it will be considered that SA 250 he has not complied with, and accordingly consequences will be there.
Thanks, sir. The next question is that for non-compliance of a law, if penalty prescribed therein is already provided in my financials, right? If the management has already provided for that, then is it still necessary to bring out the fact in the audit report?
No, it's not. But see, if penalty has been imposed and it has been provided for, that's fine. But there may be some issues. For example, if you look at Caro report, and especially on government dues, statutory dues, it said whether government dues, statutory dues are regularly deposited. So there, he can't say that regularly deposited, even penalty has been. So he has to qualify there that has not been, and the penalty has, though there is no pending demand and whatever. And sometime if, let's say, take a particular case, there is in 100% cases, company has defaulted in payment of PF and ESI dues. Suppose and it's a huge amount. At a year end, they have once before the audit, they have deposited it also, and penalty has been provided for whatever. I think still, as a EOM, I personally feel this type of where the amount is quite high, and as a EOM, this can be referred.
So as an emphasis of matter is what you're saying, it should be mentioned.
Yes. Because see, ultimately, financial statement will give an indication that though company has provided for that, but he had to incur that much expenditure, which was otherwise avoidable.
Right. No, that's right, sir. And so the next question is that if the auditor identifies some criminal issues related to, non-compliance or regulation, then is it the auditor's responsibility to, report it to the police or any of them, or it is only to the management and the people under governance is what he has to work on?
See, criminal liabilities comes in a very, very rare cases. Chalo, let's take a very interesting case. That Kurkure wala. Suppose some company is involved into that supply chain. That this cocaine issue which has happened. Suppose there is one company which has also helped in transporting that or something like that. And in the media, it was pointed out that this company was involved. Because see what happens in some cases, whosoever touches that, especially in PMLA, whosoever is involved, all are responsible for the consequences. So from that point of view, PMLA would be applicable, and accordingly, non-compliance, financial impact, and then reporting, because that tantamounts to reporting to the respective authority. But we are not responsible to report to any other authority other than Ministry of Corporate Affairs, and that also in the case of fraud only. So only fraud outside reporting is there. Otherwise, we have to simply communicate through the report, because report is general purpose financial statement. It means it is for the all regulators. So unless there is a specific reporting requirement, which I have just mentioned, that like in the case of MSME, there's a specific, in the case of Companies Act, Section 143(12) talks about it. Otherwise, there's no other reporting. And of course, in the case of now, as a reporting entity, companies are, auditors are also supposed to inform the FIU. So that also aspect has to be, but that is only very specific cases. Audit doesn't come into that category. But since you mentioned, that angle should also be examined. Are we, as a reporting entity, getting covered into that aspect?
Got it. No, thank you very much, sir. And I think a very knowledgeable and interesting session. Very well explained in terms of the sections, I think. Because actually when things are put in terms of categories and explained, they stay into our heads also. Next time I'm sure when I look at it, I am also going to remember whether it is part 1, part 2, part 3, part 4, and then definitely put that in place. So thank you very much. It was really an engaging session, and I'm sure all our participants have benefited a lot. Thank you for your time and effort, and thanks once again to the AASB board for organizing such issues.
Yes.
A great learning at my end too. So hand over to the institute.
Thank you.
Thank you so much, Anil sir, and thank you so much, Ruchi madam, for the wonderful session today we have. And Anil sir have single-handedly spoken for approximately around 2 hours single-handedly. And hats off to you, sir. You have covered all the aspects of SA 250, and while the question answer session covered a few aspects of the SA 700 also relating to the audit reporting, you have covered along with the SA 250. So thank you so much, sir, for such a wonderful deliberation. And you always blessed all of us with your words of wisdom whenever we just call you, sir. Thank you so much for your precious time. Hope our members have gained a lot through your deliberation, as well as your expert, as well as your insight, sir. Thank you, sir. Thank you so much.
Thank you, Anil, and I really appreciate your persuasiveness. You are, you don't leave.
Thank you, sir. Yes, sir. Thank you, sir. Thank you so much, Ruchi ma'am, for your giving your consent for this moderation of the webinar. Wonderfully moderated, ma'am. Thank you so much, ma'am. Thank you.
Thank you. Thanks.
Thank you. Thank you,
Bye.
sir. Thank you.